And welcome. It's Mary Ellen McGonagle here with your Friday afternoon MEM Edge show. And a very happy new year to everyone. Not a great start to the year. As usual, we're going to take a look at where the broader markets closed. We're hovering around some rather critical areas. First up before that, sharing with you some of the more critical and market-moving news last week. We did hear from the Federal Reserve, their latest notes from their meetings, and those notes did confirm that we are very conceivably at the end, certainly of any rate hike campaign, but more importantly, investors are now on the lookout for when that first rate cut will take place. We also did get key news by way of December employment data. And on Wednesday, private employment data did show that the labor market feels still rather strong. Today, we did get U.S. government December employment data, and it was a bit softer. While the actual employment data did come in a little bit above average, it was very focused. And from there, as we move through today's show, I will share with you the importance of digging into numbers such as where did employment expand and what impact it may have on that given area. Now, next week, we are not out of the woods yet. We have core CPI and PPI data, of course, very critical inflation numbers. And then also earnings season is due to begin, where companies will start reporting their fourth quarter earnings. So let's go ahead and take a look at that market and see where did we close for this holiday shortened week. And here we are with a daily price chart of the S&P 500. And of note is the fact that this broader market index did close the week down about 1.5%. And from my work, a couple of key areas to really pay attention to is the fact that we closed just below this purple 21-day simple moving average. Of note as well is that last week's volume was relatively high, so we could consider at least two of those days as distribution days. You don't want those high volume sell-off days to accumulate because it will foretell further declines. Also, we can take a look at that MACD. This black line did, in fact, cross down below the red. In no way a sell signal, but quite simply indicating that this recent uptrend has, at the very least, paused, and as we've seen, pulled back. We can go back historically to other periods, certainly this year, June, again in August, as well as September and October, where that black line down through the red did potentially foretell more. But if you take a look at that RSI, that's going to be your real key indicator, a move below that 50. We were able to avoid that on this S&P 500. So at this point in time, as we move through, I will share with you why the S&P 500 performed relatively well. We're just going to take a very quick look here at the Nasdaq Composite, down 3% for the week. A bit of a different picture there with that RSI. This index as well had that black line down through the red, but the more advanced decline, everything to do with a move away from growth stocks this week. So let's go ahead and take a look closer at those markets. We're going to use the 11 S&P 500 sectors as our guide. They're listed here as a 2-month daily price chart view. And I've added an RSI, that's that relative strength indicator. And then the sectors are sorted in descending order. And for those of you that watch this show each week, welcome back. You will also know that movement among these sectors is not going to be swift. And most likely we will see a less advanced move to this powerful or more strong upper left quartile relative to the weaker areas down here on this right period among these lower, certainly performing industry groups. So let's take a look at the stronger groups up here on this upper left quartile here, and a couple of items of note. We do still have sectors that have been up here at the forefront recently, most notably financials. They were up for the week, certainly outperforming. Also of note is the fact that next week's earnings season is dominated by large bank stocks, Morgan Stanley, JP Morgan, Citigroup, Wells Fargo, and so on. So to see this group advancing and relatively holding in well ahead of earnings is generally constructive. We'll certainly know more as they begin reporting their earnings next week. Healthcare, which has been moving up to the forefront, is now in that number one spot. Let's take a look at their performance. Very big outperformance this week as we continue to see a move into not only a somewhat defensive area, more importantly, into a sector that relatively underperformed year to date. We are seeing developments taking place within healthcare by way of merger activity and new drug developments that are really buoying this sector. From here, I also wanted to share with you some other defensive areas, certainly utilities and staples up here at the forefront. But again, equally notable is the fact that these two areas one area was negative throughout 2023, with the other group up only nominally relative to big outperformance among groups that are down here in this lower quartile, most notably technology. This is XLK. The group was down over 4% last week, and we can see we've broken this 10 and 21-day simple moving average, with this 10-day moving average poised to cross below that 21-day simple moving average. We need only go back to this late July period and September as well as October to see that oftentimes that shorter term moving average moving below the longer term, also known as a death cross, can precede more of a decline. We can also see this RSI now down below 50, and in addition, coupled with that MACD black line down through the red and high volume. So net high growth areas such as technology coming under selling pressure. And it wasn't just those mega cap names pushing these areas lower. Subscribers to my MEM Edge report will get a lot more by way of intel as it relates to other areas within technology, and then some constructive stocks within this stronger healthcare area. Let's take a quick look here at consumer discretionary XLY. This is another high growth area. Now, certainly Amazon and Tesla's 4% drop did certainly contribute to the deterioration here, but there were other areas of retail that were also under selling pressure. We can see the RSI down below 50, and then that black line down through the red for the MACD. So net, a bit more of a move away from growth and into value stocks. And we'll get a little bit more into that as we move through. From here, I'm going to take us over to a 2-month daily price chart view of sub-industry groupings that are within these sectors. It's very critical to know where money flows are taking shape among those 11 sectors, but equally important is to have a good sense of precisely where you want to participate in that outperforming area, and of course, make sure you're not overweighted in those areas coming under selling pressure, particularly if you have a shorter term investing horizon. So let's go ahead and take a look through these ETFs. And Biotech's again outperforming this week, up about 0.3%, but certainly relative to a negative market. That is one area that has been helping healthcare advance. We can see, however, we are at risk, not certainly heavy risk. We could easily see potentially just a pause as that MACD is poised to potentially post a negative crossover. And moving along also in healthcare, this is IHI Medical Devices ETF. It did pull back this week, but very orderly to this upward trending 21-day simple moving average with positive RSI characteristics. Talked about bank stocks. This is KRE. And these are more regional banks, but you can see net generally finding support at that 21-day simple moving average with that RSI in positive territory. Now, as we move through these various industry groupings, a couple of items very notable. One is the fact that we are seeing interest rates creep up. We closed last week with the yield on that 10-year Treasury just inching above 4%. And for those of you that follow the markets closely, you'll know that 4% yield level on that 10-year Treasury can be critical, certainly a psychological number that can potentially, and we've already seen it certainly last week, negatively impact particular areas such as those growth stocks. Also of note is the fact that small caps, which had a tremendous advance November into December, pulled back pretty substantially, down about 3.5%. We are still holding on that RSI, but certainly the bloom is a bit off the rose for those small cap stocks. Now, among technology, I mentioned I would share with you two critical groups that would impact that particular sector, and certainly semiconductors is one of them. This is SOXX, the iShares Semiconductor ETF, down almost 6%. And you can see going into this week, it certainly was an overbought area by way of this RSI above that 70 level for about 2.5 weeks. So a pullback seemingly imminent. We did get that, but this is an area that I certainly am keeping a close eye. Not all areas came under intense selling pressure. There are still stocks, namely those on my MEM Edge suggested holdings list, that are holding their upward bias. So moving through, taking a look at another key area within technology is software stocks. I use the ETF IGV, and we can see again, it is an area that broke below the 10 and 21-day moving average. Relatively high volume, but certainly near term, we do have a negative bias for the overall group. So you will want to take a look at some of your heavier holdings that might be in either of those areas and take note. Now, from here, I did want to share with you, we talked about the employment data, and I'm going to go ahead to StockCharts.com, their main page here, and share with you what can conceivably be a short-term way or a very quick and easy way to get in front of groups and areas that are potentially on the move. And in fact, today's data relative to the top performers in the S&P 500 for today, Friday, there was movement among a particular industry group, and this will tie in directly with where within the US in the month of December, there was quite a bit by way of increased employment. So if we take a look at this group of the top performers, in essence, you're on the lookout for a theme. And first up, we can see Southwest Airlines, American Airlines, and Delta Airlines, as well as Royal Caribbean and United Airlines. And one of those areas where there was increased employment, as you can guess, was that leisure area. And certainly these areas would apply. Next week, we do have Delta Airlines due to report their earnings. And we can take a quick look at this particular chart, and we will see that the advance here in November was pretty significant. Also of note is that the group pulled back for certainly the second half of December. But let's take a look. Today's 3.5% rally has pushed Delta Airlines back above the shorter term moving averages, with this RSI now in positive territory. On the lookout now for a black line up through the red MACD crossover to indicate a potential new uptrend. But again, of note is the fact that Delta will be reporting their earnings, and you'll want to know that earnings, certainly buying stocks going into earnings, is not an activity that I would advocate. But let's take a look at a couple of other names here. Southwest Airlines also signaling a potential downtrend reversal. Keep an eye on this name because it has had an attempt here, certainly in early December, and faltered. But if we can get back above this 200-day simple moving average, it could be interesting. And last up here, when looking at names here at the forefront, CTLT is another name that has been attempting to reverse its downtrend. We're not seeing a whole lot of volume from here. I'm going to pull up that full quote, and you will see it is in the healthcare area. It is a smaller cap pharmaceutical stock, about 8 billion, but on the lookout here again for a more pronounced move above this 200-day simple moving average, because it does have positive momentum with that RSI. Now, from here, we're just going to take a quick look at two Vanguard funds, and I would urge you just have them on your radar so you can stay on top of potential moves in or out of growth, in or out of value. So first up is VUG. This is the Vanguard Growth Fund, and you will see that it did pull back. Certainly no big surprise given what we've just reviewed versus growth versus value. But from here, we can take a quick look at VTV, and that is the Vanguard Value Fund. And you can see how it held up really quite well above this key 10-day simple moving average, certainly relative to the Vanguard Growth Fund. From here, I did want to share with you some names that are top holdings of the Vanguard Value Fund. And from there, you can certainly have a better understanding of why some of these value funds are, in fact, outperforming. From here, we'll take a look at Berkshire Hathaway's fund, which is one of the top holdings of VTV. And this daily price chart using that ticker BRK/B, you will see that for the week, it did certainly advance. We had a nice 5-week base breakout on nice volume with a potential flag formation forming for this particular stock. And I will share with you other value holdings that are top among VTV, but from here, I was going to go ahead and show you some of the top holdings in Berkshire Hathaway's fund, and here we are. This particular list at this time is alphabetical, but I do want to then segue and share with you using that RSI, and then in descending order, we'll take a look at these 9 top holdings in the Berkshire Hathaway's fund, and let's take a look. American Express has been a top performer, big downtrend reversal, and there are certainly other credit card and payment processing companies that have been on the move higher as spending among consumers has increased. And then also those that travel will be using their credit cards. And let's go ahead from here and take a look at Bank of America. This is one of those banks that is due to report their earnings next week. You can see today it did post a nice 2-week base breakout and on significant or certainly healthy volume. KHC is Kraft Heinz, another downtrend reversal, and the stock also experienced a base breakout on Monday, which it has retained. So you can see why this particular top holding was Berkshire Hathaway was on the move last week. But you do, of course, also want to be aware of those weaker stocks. So from here, I will segue. First up, though, is the fact that energy is continuing to overall underperform. It had a tough year last year, but it is not among those sectors that floundered last year and are faring well, certainly into the new year. But I would be remiss to not share with you this chart of Apple, of course, a very heavyweight, Magnificent Seven name that did fall out of bed among a number of analysts and Wall Street downgrades to their outlook due to iPhone issues. And we can see that the stock on Tuesday broke below this key 50-day simple moving average, finding support currently at that 200-day. It will be critical to see that that takes shape. But of note is the fact that we did get this signal of sorts back here in mid-December with this black line down through the red in Apple, as trouble was beginning to surface before we had this week's pronounced break. Now, from here, I did want to talk a little bit about sell signals. If you have a holding, certainly such as Apple and any number of other stocks, what you would want to be on the lookout for as a signal that the stock could have further downside. So we are looking at Apple, this break below these key. I'll go ahead and mark this up so that you can use this as a guide for holdings that you might own that appear to be under some selling pressure. So again, first up was that black line down through the red. Again, not a sell signal. You will want to at least make note that any potential uptrend is beginning to potentially falter. And what we want to do from here is take a look at how your given stock performs around their key moving averages. So Apple did break below that 21-day simple moving average. And then as that deterioration begins to emerge, you will see this shorter term 10-day moving average cross below the longer term 21-day. That is a death cross, but again, a secondary signal because we already had the RSI break below 50. And from my work, any of these names, if you do see a very decisive break below this 50-day simple moving average, on relatively high volume, statistically, and particularly if you're a near-term investor, that is a sell signal. And you can see since then we had seen continued deterioration with this moving average convergence, divergence, now in negative territory. One other view that I will share with you, we'll get back to this daily chart in just 1 minute, but I do want to also share with you a weekly chart as your guide. And I certainly will share with you another example, but on the weekly, this is going to be for longer term investors using the weekly chart as your guide. And Apple, probably not the best example. The stock has held in relatively well, even throughout the 2022 bear, but you do generally want to be aware on that weekly when that RSI trades below this 50, and it does in fact generally proceed further downside. Also, again, that MACD black line down through the red. Keeping with that theme as far as being on alert for your individual holdings and when you may want to trim positions, I am sharing with you a view of IGV. This is that software ETF. And in this particular chart, I did, and you can certainly do the same. If you go down to this lower area, you can actually select your start and end date for a given chart. So for this view of software, I did take us back to November of 2021 into November 2022. And in essence, we did see the beginning of that 2022 bear market as we entered the beginning of 2022. So let's go ahead and just mark this up quite quickly here. I'm taking us back to 2022 with IGV, and this is the very beginning of December when the group fell below this 200-day simple moving average. We are looking at a daily price chart. And in fact, it did, as you can note, foretell quite a bit of deterioration before we had a couple of head fakes into this year's. Certainly the bottom was among many growth stocks, did take shape at the end of 2022. But again, keying in on that industry group. And then from there, you will want to take a look at your individual stock. The real weakness in growth stocks did begin in November of 2021, something I'm very, very cognizant of. Again, my MEM Edge report, we were aware of that and did begin peeling back. But once that group pressure begins to emerge, then you can know that it is system-wide and likewise a group or certainly a lower movement that could be widespread. From here, I'm going to take us with IGV to a weekly view. Again, that weakness did begin in among software as well as other growth areas toward the end of 2021, and it did become more pronounced into the beginning of 2022. So what I am sharing with you is in no way what I am anticipating for software and other growth stocks at this point in time. I do want to be clear with that. This is very much for educational purposes. There are many groups that you can use this actual view, but on that weekly, in this case, for this software ETF, this move of the RSI below that net neutral 50, and then we did go below that 10-week or 50-day simple moving average, very high volume indicating distribution, and then below this 40-week longer term moving average. And again, we're not at that juncture at this point, but it is certainly worth noting should we see continued deterioration among growth stocks as we move forward. At this point in time, it is very much a wait and see. And it's also very encouraging that we are seeing areas that are holding in well and not seeing selling pressure that is being experienced elsewhere. META is Meta Platforms, holding in really quite well. And this type of price action among these big leadership growth names is encouraging, certainly at this time. And last up here, I will share with you a couple of other value names that are heavyweights among that VTV Value Growth Fund. Let's take a quick look here at Eli Lilly. We talked about healthcare being among those areas that outperformed this week, and we can see that Lilly had this gap up on Wednesday. And in so doing, we are looking at a daily price chart of Eli Lilly. And from here, we can see that MACD is just now entered into positive territory, black line up through the red. And then likewise with that RSI, we want to see this gap up advance into a base breakout, which it did. So net, quite constructive looking. And then interestingly, we did see positive movement among insurance names. And this is something I've talked about in the past, where these insurers, depending whether it's life or auto and otherwise, they've been able to raise their rates in an inflationary period with not a lot that we as consumers can do by way of pushing back. But here we are with Allstate, another stock that gapped up into a base breakout and into a nice uptrend with that MACD black line up through the red. And then one last name that we can take a look at also in this insurance area is Metlife, MET, also exhibiting this base breakout on relatively high volume and into a nice uptrend. And I will leave it at there this week. Everyone have a fantastic weekend. We'll look for you again here next Friday afternoon.